Alright guys, so we are going to make this short video essentially talking about what could derail the stock market rally from here. Now, we've covered AMC. Go ahead, watch the last video. That is talking about earnings in this next upcoming week and kind of what I expect as far as the bullish rally. So go ahead, watch that video, the last video, if you guys want something more specific around AMC. Yes, we will go over the Ortex data, a little bit of the technicals here in this video, but by and large, I want to talk about the stock market as a whole. What is going to derail this rally? Why is the stock market actually rallying? Because a lot of people might not know. So let's get into it. Hit that like button, subscribe to the channel, do what you guys got to do in that regard. But the first thing I will tell you guys why the stock market is rallying is because investors are expecting inflation to start coming down. That is it. That's the bottom line. It's not because earnings were good. Earnings were actually bad. They could have been worse, and that's a reason to be somewhat bullish, but they were not good. It's the simple fact of investors expect inflation to be coming down. Now, we don't have the next Fed meeting until September 21st. So we're going to get the next CPI report August 11th for the month of July. Then we will get the second CPI report coming September 11th for the month of August. And then we have the Fed rate decision September 21st. So you basically have two of everything. Two CPI, two PCEs, two of everything. Two employment reports, just everything. So we have a lot of data until the next Fed meeting. But what the markets are saying is they expect the Fed to raise rates 50 basis points at the next meeting, and that we expect inflation has peaked and will start to come down. That's the big question, and that's really the bottom line to this. If you are buying stocks right now just because the stock market is going up, well, you are a part of investors that expect inflation has peaked. Now, why I'm specifically saying this in the way that I'm saying this is because I hear a lot of people talking about inflation is going to get much worse, that, inflation is here to stay. People are pretty bearish on inflation, right? They think it's going to be around a while. But then again, they're bullish on the stock market. You can't think inflation is going to stay around a while and continue to go higher and also be bullish on the stock market. I mean, I guess you can, but you'll be wrong, right? And that's a big narrative that I have really seen playing out as of recently. Whereas, if inflation does peak, and we have seen the peak at 9.1% CPI, well, then you're probably on the right side of the markets to be buying the stock market right now. If you don't think it has, if you think we have more room to go with inflation, and specifically if you think inflation will not go down that fast, well, we're in for more pain in the stock market because the Fed will raise rates. Now, a lot of people have started to say as well, started to get this narrative in mind that because the economic data is starting to take a turn for the worse, that potentially the Fed will not raise rates as aggressively because of that, when that is absolutely not the case. It doesn't matter what happens with the economy, the Fed will continue to raise rates. It only matters what happens with inflation. So I think in a weird way, the better the economy stays for, over the next months, that's going to be a bad thing, especially if inflation does not come down. Because typically what happens when you get inflation like this, where we have not gotten inflation like this in a very long time, but essentially this red line is inflation, the blue line is the federal funds rate. Every single time we have seen inflation this high, you have had to bring the federal funds rate up at least to match the rate of inflation, if not go higher than the rate of inflation. And starting to cut rates or pull back too soon can have really bad consequences for where inflation goes. So until we get CPI reports that are coming in at, let's say, 5 or 4%, you're not going to get the Fed that stops raising rates. They will slow down, and that will be seen as a bullish thing. But a small recession could actually be a good thing. It could actually force inflation down in a much more dramatic way. You will see every time you have these gray lines, right, the gray spaces, you have seen the red line go down. You have seen inflation go down in a pretty sharp manner. And that would be a bullish thing, right? That would get back to, funny money, easy money a lot faster. But if we can hold off a recession and that doesn't happen for, let's call it 3 or 6 more months, that's not going to be a positive thing for equity markets, because the Fed will have to keep raising rates. And actually what we're seeing right now is very interesting. Investors, they are still selling off the bonds. They're still selling off the treasury bonds. You could see the yield curve inversion. Let's go ahead and pull it up on CNBC. 2 to 10 year spread. And the yield curve has inverted another 4 basis points for the day, almost about 20%. We are currently inverted 0.23 basis points. So what's happening? Investors, they're selling the 2-year bonds because they expect inflation to be higher than the interest rate you get paid out on a 2-year bond, which is about 3%, or they expect the Fed to make a policy error and for the economy to go down the toilet over the next 2 years. But then they expect over the next 10 years, the economy will be just fine, inflation will come down, and they would make money on their bond purchases. So long story short, the inverted yield curve is still saying that we expect pain over the next 2 years, and we expect higher inflation than 3% over the next 2 years, or at least over the next year. So it wouldn't make sense to buy those 3% yielding bonds. If you had, let's say you bought a two-year bond that yields you 3%. And let's say you have 1 year where inflation is 3% and 1 year where inflation is 4%, well, you're going to lose money on that bond. Let's say you have 1 year where inflation is 3%, the next year inflation is 2%, well, you'd make money on that bond. It might make sense to buy that bond. If investors did buy the bonds, then it would drive the yields down. Yields go higher in bonds when investors sell off those bonds. So investors are selling 2-year bonds. There's not enough demand for 2-year bonds. That is what is driving the yield up on the 2-year. People are buying the 10-year, driving the yield down. That's where you get the yield curve inversion. That's where you can actually get paid out more on a 2-year bond than a 10-year bond. So that in a nutshell, really what is happening right now. And long story short, through all of this is, if you think the bottom is in for the stock market, you think inflation has peaked, or at least that should be the running theory. If you have a theory on why you're buying into the markets specifically right now, as the markets are up over 10% from the lows, it would be you expect inflation has peaked. If that's the case and you are confirmed to be right on that, you're going to get paid out, you're going to do very well. And hopefully you have had a portfolio and you've been adding to it this whole entire time. Either way, you'd be doing fine as of right now. But if you are somebody that thinks inflation will go higher, then I would not FOMO into this market, because the markets will come back down. The markets right now, very hyper-focused on inflation and the Fed. But we do have time until the next Fed meeting, which comes September 21st. And what we actually seen happen today with the PCE data, well, not so good. So PCE data did come in. Let's go ahead and pull this up right here. The personal consumption expenditure price index in the United States increased 6.8% year over year in June of 2022, the highest reading since January of 1982, and above 6.3% in each of those previous 2 months. Prices for goods increased 10.4%, and prices for services 4.9%. Food cost was up 11.2%, and energy jumped 43.5%. Excluding food and energy, PCE inflation accelerated to 4.8% from 4.7%, above forecast of 4.7%. So we are seeing a month-over-month increase to core PCE, as well as a month-over-month and year-over-year increase to regular PCE. This is the measurement of inflation the Fed pays most attention to. But like I said, we have 7 weeks and 5 days until the next Fed rate decision on September 21st. So one data point is not going to cut it. It's not going to give us a clear signal that inflation is either here to stay or, going away, right? We're not going to get any indication of that. But around the CPI reports, coming August 11th and September 11th, those are going to be the days that you want to mark on your calendar, because those will move around the expectations for what the Fed is going to do. Right now, 96% of investors are expecting a 50 basis point rate hike. 4% are expecting a 75 basis point rate hike. If CPI reports are bad and we start to break above 10% CPI readings potentially before September, well, you might even get yourself a 1% rate hike. And the markets, they're not expecting that. So basically, we've rallied so much in anticipation inflation will come down. If it does not, you could give away all those gains plus more in the event that does happen. Now, I'm not trying to be a fortune teller here, just shoot it to you guys straight, because I don't really know. To be honest, I don't know if inflation has peaked. I don't know if inflation will come down. I don't know if it'll come down and then go back up. What's going to happen in that regard? But I know the Fed's not going to stop raising rates. So you have to be comfortable with your decisions here and know what you are doing at the very least. Know if you are buying stocks right now and inflation does not come down, you will see pain, because I know a lot of people invest, money you probably shouldn't, right? You should only invest what you can afford to lose. In a worst case scenario, right, you could afford to lose your whole entire portfolio. Obviously, that's probably not going to happen unless an asteroid hits Earth or something along those lines. But still, you need to know what is happening in the markets at the very least. So there is that. On top of it, you do have AMC. Let's go ahead and pull this up, the option activity for the day. 2 orders totaling 100% positive order value, worth about $40,000. You did see an October 21st, $18 call coming through for about $26,000, and an August 5th, $17 call coming through for about $14,000. A lot of people are on vacation right now. There's not a lot of volume across the board. AMC had a very low volume day, as well as the broad markets, but nonetheless, it's positive order value. Now, as far as the cost bar max, that is 10.5%, the cost bar average of 9.24%, and the cost bar minimum of 6.56%. $1.47 billion worth of short positions. Estimated short interest of free float is 19.59%. Free float out on loan 28%. Shares out on loan 145 million. Days to cover 3.45. So the data here looks pretty darn good in my personal opinion, and you do have AMC earnings that are still upcoming, so keep that in mind. AMC earnings do come out on August 4th, and Adam Aron has talked a big game over the last couple of weeks about squeezing out the shorts and really, making them essentially choke on that. You guys have heard that a lot, and that's what we can come kind of to expect, something positive, right? I think we're going to have good earnings, and I think we're going to have some good catalysts to announce. But right now we sit in between a rock and a hard place, in between the 50 and the 100-day moving averages at about $14.56 as of right now. 100-day moving average is about $1 more to the upside. The 50-day moving average is, again, about $1 more to the downside. So you're pretty much right in the middle. And as long as we stay above the 50-day moving average, that's a very bullish sign, because we were only above this 50-day moving average for like 2 or 3 weeks here in March, as we did get this big rally up to like $35, $36 at the peak. Other than that, we have not been above the 50-day moving average since November of 2021. So we're obviously still in a bullish trajectory. If we can get above the 100-day moving average, that is even better, because we have only been above that 5 trading days since November 2021. Right? You have not been above that for too long, and we were above it for 5 trading days right here. 5 trading days in March, 5 trading days back here, what we just seen in July. If we can break out above it again and hold above it more than 5 days, that would be a signal that I would be watching for on a technical basis for another major rally to the upside. Now, volume for the day, like I said, 18 million shares, not a very large volume day, but it was eventful. There was a lot going on. AMC did not rally along with the broad markets because the broad markets didn't rally. This was a tech stock rally, and not all tech stocks, but the tech stocks that have the largest weighting that just reported earnings, like Apple, Amazon, Google, Tesla. Those stocks did very well. Other stocks, not so much. So that is going to be all for this video. Hit that like button and subscribe to the channel. Thank you guys for watching, and I will see you in the next one.